now we're going to move on to Chapter 2 and talk about the different types of accounts in a bit more detail. In Chapter 2, they begin to explain how to go about recording a transaction in accounting. But the first thing you have to understand are the types of accounts that exist and how do you go about increasing or decreasing those accounts. So first of all, we've talked about the accounting equation. We've talked about assets, and that assets have to equal, a total of assets have to equal liabilities plus equity. So let's talk a little bit about asset accounts. Asset accounts, again, are those things that are owned or controlled by the company. And there are different types of assets. What they do here in your book is they try to just explain the most common types of assets that most companies will have. Probably the easiest one to understand is cash. If you have some cash in the bank, or even cash in your drawer in your office, all of that is an asset to you. It's money that you have to buy things or to pay for expenses. So cash is pretty easy to understand. Another one is accounts receivable. This is where you have provided a service or a product to somebody and they are paying you on credit, that you've allowed them credit instead of them having to pay for the item up front with cash. So that is money, you've already provided the service or the product, and this is money that you have a legal claim to because they owe it to you for what you've already delivered to them. The same thing with a note receivable. This is where you've loaned somebody money. It's different than accounts receivable in the sense that sometimes with accounts receivable you've provided a product or service. A note receivable might be an actual loan that you've made to somebody and they have promised to pay you a certain sum of money. It's just a different type of receivable that we place in a different account just to keep track of it a little differently. Let's skip a second down to supplies and equipment. Again, these are relatively easy things to understand. You buy certain supplies and you don't use them all immediately. So it's an asset to you until you've used it up. So the supplies that you have on hand are an asset. And they give you some examples there of what those might be. Office supplies, store supplies, those types of things. Same thing with equipment. Equipment is an asset. Any equipment that you use in your company, generally speaking, you probably had to pay money for it. It's worth something, so it's an asset to you. However, equipment tends to wear down. It only has a certain shelf life, so to speak, and so there is depreciation on equipment. And depreciation is an expense. We'll talk more about that at a later point, but equipment over time will lose some of its value. Another basic asset is a building. If you own a building, then that whatever that building is worth or whatever you paid for it, that is the amount of that asset. Same thing with land. If you own land, especially obviously the land that your building is sitting upon, that has value. That's an asset. All of those things are pretty easy to understand in terms of assets. The one that's a little bit more difficult, going back up here, are the prepaid accounts. When sometimes a company will pay their rent in advance, or they definitely usually pay their insurance in advance. So if you pay your insurance for 6 months, that's considered a prepaid asset because you now have that insurance, it's good for 6 months, and you don't owe any more money on it. You've already paid that premium up front. However, as each month goes by, whatever you paid for that, let's say you paid $600 for your insurance premium, and it's good for 6 months. Well, at the end of 5 months, it's no longer worth $600. It's only worth $500 because you've used up $100 worth of the premium. So that prepaid account, that prepaid insurance, continues to decrease as time goes by till it works its way down to zero, and then you have to pay for another 6-month premium. So a prepaid account is an asset until you've used it up. And then as you use it up, you have to expense it. And you would do that through an expense account. So after the first month, you would have to charge $100 of that prepaid insurance to insurance expense. Again, I know it could be a difficult concept at this point, but we will be talking more about that later. And then let's turn to liabilities. Liabilities, we've already talked about this in Chapter 1, but liabilities refer to those claims that outside people, that creditors, have against your assets. These are people that have a right to get money from you because you have entered into some kind of agreement with them, or they've provided you with some type of service or product. Again, the most basic type of liability account is accounts payable. You bought some material on credit, and now you have to pay for that material or that product. Same thing's true of a note payable. This is where you have made a promise to pay somebody a certain amount of money. It may be a bigger loan for a building or equipment or something like that, and so you're having to pay back that note, and there's an actual promissory note that stipulates the terms of that particular debt that you have. Let's move down to accrued liabilities for a second, and then we'll come back to unearned revenue accounts. An accrued liability is generally, the most common one is wages payable or salary payable. Generally speaking, we don't pay somebody until after they've done the work. So if somebody works for you and gets paid monthly, then at the end of the month, you may owe them for a month's salary, but you may not pay them until the Friday of the first week. So at the end of that particular month, you have an accrued liability, meaning you owe, let's say, $1,000 to somebody, and it will be paid the next week. But at the end of the month, at that particular point in time, it's a liability. You owe it, you haven't paid it yet. There's also taxes payable, interest payable, there could be other things like that, but these are things that will eventually become an expense. When you actually pay those wages, it will become wages expense. But at the time, while you still owe it, it is wages payable. And then going back up to the unearned revenue accounts, this is where you have received money in advance for something that you have not yet delivered the product or the service. So when customers pay in advance, the revenue recognition principle requires that you consider it as unearned revenue. You haven't done the work yet. You haven't delivered the product yet. So it's not really considered revenue to you yet. It's a liability, meaning you have to perform the service or provide the product before you actually can consider that revenue. So you record these in liability accounts, and the names can vary: unearned subscriptions, unearned sales, unearned ticket revenue. But again, when the product or services are later delivered, the earned portion is transferred to the revenue account, and that revenue account might be called ticket sales, store sales. Again, probably not totally clear yet, but it's a basic overview. And then we've talked about equity accounts. Again, let's quickly go over that. Generally speaking, when an owner invests in a company, they get common stock in exchange. They own stock in that company. The amount the owner invests is usually considered, or it's put into an account called common stock. The amount that a company pays out in dividends to its shareholders goes into an account called dividends. And then, we've again already discussed this, but just quickly to review, revenue and expense accounts. Revenue and expenses both impact the equity, because if you have a net income, that increases your equity. If you have a net loss, it decreases. In order to determine net income or net loss, you have to take all of your revenues, subtract all of your expenses, and that determines if you have a net income or a net loss. Then that, again, will either increase or decrease the equity. So if you look at the chart up here, you still have assets equal liabilities plus equity. Equity is determined by taking the investment that the owners have made, the common stock amount, subtracting any dividends for that period, and then adding the revenues and subtracting the expenses. Now, we usually do this part first. We take all the expenses, take all the revenues, subtract expenses. That gives you your net income or net loss. If it's a net income, it gets added to this. If it's a net loss, it gets subtracted from it. So that's just a basic overview of the accounts. What we're going to turn to next is how to go about doing double entry accounting, and that is going to be probably the most important thing for you to understand in this semester. We'll turn to that in just a second.